Welcome to this explainer. Okay, today we are absolutely going to crush the highest stakes financing topics for the Florida Real Estate Sales Associate exam. If you're studying for your license right now, well, you already know financing is one of those heavy-hitting sections. It's literally the stuff that can make or break your final score. So we're going to distill exactly what you need to know about mortgages, loan types, and the secondary market, so you can walk into that testing center with total confidence. Let's get started.
Here's our quick agenda for this explainer. First, the note versus the mortgage. Second, clauses and property transfers. Third, conventional FHA and VA loans. Fourth, secondary mortgage market roles. And finally, an interactive exam practice quiz.
All right, Section 1, the note versus the mortgage. Let's get right into it. So here's the absolute core difference you've got to memorize. The promissory note, that is the actual legal evidence of the debt. Think of it as a negotiable financial instrument that acts as your personal IOU to the lender. It lays out the interest rate, the payment terms, the maturity date, the whole shebang. On the flip side, the mortgage is the security instrument. It's what pledges the physical property as collateral for the loan, which creates a voluntary lien against the real estate. Basically, you sign the note to promise to pay, and you sign the mortgage to say, hey, if I don't pay, you can take my house. Now, because Florida is a lien theory state, the borrower, aka the mortgager, retains the actual title to the property, while the lender just holds a lien. This is huge. It means if things go south and a borrower defaults, the lender can't just automatically take the house. No way. They have to actually file a lawsuit in circuit court to foreclose. And this judicial foreclosure process, it usually takes anywhere from 8 to 14 months in non-contested cases and 18 months or more if it gets contested.
Moving right along to Section 2, clauses and property transfers.
Okay, the acceleration clause. This essentially hits the fast-forward button on your debt the exact moment you default. If you miss your payments or violate the loan covenants, the lender doesn't just sue you for those few missed payments. Nope, they invoke the acceleration clause to demand the entire remaining balance of the loan right then and there.
Let's test this right now. If your buyer stops paying their monthly bill and misses a few payments, which exact mortgage clause drops the hammer? You guess it, it's the acceleration clause. It literally accelerates the maturity date of the loan all the way to today.
Now let's look at the due on sale or alienation clause. This is a lender's ultimate protection against unapproved transfers. It strictly prevents a new buyer from just swooping in and taking over an existing low-interest loan without the lender's permission. Basically, if you sell the property, the loan is due. It completely alienates the borrower from the property. Think about this micro story for a second. If ownership transfers, but the bank isn't paid off from the proceeds of the sale, which clause did they just violate? That would be the due on sale clause. The lender is going to immediately call the loan due. All right, listen up, because this is a massive exam trap. When a property is transferred with an existing mortgage, it usually happens in one of two ways. In an assumption, the buyer takes on personal liability for the debt. But the original seller actually remains liable too, unless the lender executes a formal release of liability, which is called a novation. Now, on the other hand, when buying subject to, the buyer agrees to make payments, but is not personally obligated to pay the debt. That means the original seller remains entirely on the hook for the promissory note and any potential deficiency judgment. Scary stuff if you don't know what you're doing.
Let's jump into Section 3, conventional, FHA, and VA loans. When we compare the big three loan types, it breaks down like this. Conventional loans use private funds, and if the loan-to-value ratio is above 80%, which means the down payment is less than 20%, they're going to require private mortgage insurance, or PMI. FHA loans, on the other hand, require a minimum 3.5% down payment, and they actually insure the loan against lender loss, which is why they charge an upfront and annual mortgage insurance premium, or MIP. Finally, VA loans guarantee a portion of the loan for the lender, allowing for up to 100% financing, meaning zero down payment, and they require a funding fee instead of your typical monthly mortgage insurance. So, a veteran can totally reuse their VA loan benefit, but there are some pretty strict rules here. Their full entitlement is only restored when the original loan is completely paid off. If a veteran sells their home and a non-veteran buyer simply assumes that VA loan, the veteran's entitlement remains tied to that specific property. They literally cannot use it again to buy a new home until that's cleared up.
All right, Section 4, secondary mortgage market roles. Keep in mind that the secondary market exists strictly to circulate the mortgage money supply. Think about it. When your local bank gives out a mortgage, their cash is depleted, right?
Well, the secondary market steps in and buys that mortgage from the bank, giving them fresh cash so they can just keep making new loans to new home buyers in your community. It keeps the whole system flowing.
Warning, this is a highly testable trap that constantly trips up students. Fannie Mae and Freddie Mac are government-sponsored enterprises that purchase loans. They buy conventional, FHA, and VA loans, but they do not insure them. On the flip side, Ginnie Mae is a government agency under HUD, and they are the only one that actually guarantees mortgage-backed securities backed by government-insured loans. Remember this golden rule: Fannie and Freddie purchase, Ginnie Mae guarantees.
Okay, Section 5, Interactive Exam Practice Quiz. Let's see what you've learned. Question 1. A buyer purchases a property subject to. They default, and the bank forecloses. Who is liable for the deficiency judgment? Take a second to think about it.
If you guessed the seller, you absolutely nailed it, because Subject to protects the buyer from a deficiency judgment, leaving the original seller completely holding the bag. The seller is still the only one bound by that promissory note.
Next question. Let's see if you successfully dodged the trap we explicitly warned you about just a minute ago. Which secondary market agency guarantees mortgage-backed securities instead of purchasing them? The answer is Ginnie Mae. Why? Because you remembered that Fannie and Freddie only purchase loans on the secondary market. Ginnie Mae carries the full faith and credit guarantee of the federal government.
Question 3 is a classic military financing question. What is the main benefit of full repayment of a VA loan balance?
Exactly. It's the restoration of eligibility for future use. Paying off that balance in full restores their entitlement so they can go out and secure another VA loan in the future.
As we wrap up this explainer and you finish your studying, I want you to ask yourself this final question. If a client asks you tomorrow to explain the massive financial liability difference between an assumption and taking a property subject to, could you protect them from the trap? Because mastering these concepts isn't just about passing a multiple-choice test, it's about confidently protecting your future clients in the real world. If your seller is considering letting someone buy their home subject to, you now know they are taking on a massive, massive risk. Keep reviewing these concepts, trust your preparation, and go crush that exam.